All right, so then let's get started. So this week I want to, hopefully you guys had a good first week last week, had a nice weekend. This week I want to focus on getting to the cash flow statement, which is dependent on a couple of supporting schedules, depreciation and working capital. So I want to get through that. You know, it's a short week, we just have 3 days. So today I want to kind of recap where we're at, go through projecting cash flow, talk about how to project cash flow, and then start talking about the supporting schedules, mainly depreciation. Tomorrow I want to really focus on depreciation, straight line depreciation, accelerate depreciation, so the different methods of depreciation, and talk about how to use that as a way to defer taxes. And then on Thursday, working capital, talking about what working capital is, how to project working capital. If we do have some time, start to talk about the balance sheet. So that's the focus of week 2. And then by next week, we'll be thinking about completing the model, doing things to interpret the model, maybe some debt raising, share buybacks, and things like that, and then evaluation. But, you know, I said that I would mention a little bit about, you know, networking and things like that. I like to do that periodically. I think it's still a little early. I mean, you really only had like 3 days, well, I guess if you count the weekend. I don't know what the weekends were like. But I would recommend to take a couple weeks. But what I do recommend is starting to restructure your resume. So some guys have asked for meetings, and my recommendation is it's not worth time to meet unless you have your resume restructured in this format. We can still talk, but I mean, I'm basically going to say the same thing. But let's just touch base. But I think really to be productive, start to look at this. This will help you think about, have I done enough yet to really start thinking about resume and networking? To me, this is you marketing yourself. This is the first step that anyone sees in terms of what are you doing, right? So I would definitely recommend this format. I'm going to email this to you guys. This has been set up in tables so that if you email your resume on some sort of Dropbox and it gets scanned in this table format, it'll scan properly, if that means anything. But no matter what you're doing, this is what you should have. Most of you have already graduated, so I would just recommend to put your work experience up first. Yeah, work and leadership. I opened the one for the summer guys, but I'll rearrange. You probably don't need leadership anymore. You know, if you've recently graduated and you don't have enough work experience to fill up your resume, you know, sometimes people work and leadership, some other things there just to, you know, extracurricular stuff, just to kind of beef up your resume and demonstrate better what you're doing. But I would definitely, if you've graduated, move education down. Keep education simple. Notice how this is laid out. Obviously, I think everyone knows the format with the graduation on the right. But this is where I'd recommend putting, if you're looking to save room in your resume, extracurricular activities, if you're part of any organizations, relevant coursework in bullets like this, grades, honors, relevant coursework, colon. Leadership experience, colon. Don't do a whole section for leadership anymore. It's too messy. Your resume should have just 3 solid sections: education, experience, and then other activities and interests. And if there's anything related to your university, it should go under the university section. Otherwise, I'd look at your university and think, oh, you didn't do anything. It should be under. I see a lot of people having like leadership experience as a separate section. You shouldn't have that anymore when you are trying to save room for deals and stuff. Then work experience. So this is what everybody should aspire to have. And everybody gone through this program have had at least some subset of this, right? I obviously put the name of the firm, right? I just kept it vague because it depends on what you're working for. The firm, investment banking analyst, M&A advisory services. You can just adjust that, being more specific to whatever you want to do, whatever you're focused on. NYMEX, Kerber, it's pretty much that. With the exception of Wyndham, is more private equity. Yeah.
So for where it says investment analyst, is it best to like write internship or just keep it simple as IB analyst?
I would say investment bank. And if summer they put summer analysts, you could put fall analyst to indicate that's not a full-time position. I would do something like that. I say fall analyst. Actually, good point. And definitely, and I'd recommend this for all your different levels of experience in your resume, not just this summer, is to have a bullet that explains what you're doing on the team. So when we do our one-on-one sit-downs, I'm going to kind of go through your whole resume. And I always see this lacking. I see a lot of guys, you guys are taught to have action words, which is good. Research this and worked on this, but I don't know. I still don't have a good idea as to why you were hired into the team. What was your point? What team were you working on? What group were you working on? So the first bullet of every experience should explain what you were doing on the team. What was your purpose there for the internship? So here was worked on or assigned to, and be as specific as again, buy side and sell side M&A transactions or various transactions. If you did a whole bunch of different things, some people have done an underwriting and then an M&A and then an LBO. So you don't want to, but just then you generalize it. But what types of transactions and what types of industries? You need to make sure that people know that you're staffed on deals, right? They could be early stage, they could be mid stage, they could be late stage, but everybody is staffed on deals, and you need to make sure that that's clear, right? There are two things that's going to set you guys apart from people at most internships and other internships. Is one, that you're not just sitting around doing research, you are staffed on stuff. The stuff has a purpose. That's one. So you got to make sure you are assigned to transactions. A lot of internships are just kind of sitting around getting thrown updates to presentations. Right? Yes, you're updating presentations, but it's for a finite purpose. And then two, that you're actually responsible for the modeling and the valuation and the analysis, as opposed to just being an assistant for an analyst and being thrown a bunch of stuff saying just update this, right? So it is important that you demonstrate that. So currently working on transactions in this guy said specialty chemicals, metal, telecom, whatever industries. The types of transactions, the types of industries, bullet one. Second, the next two bullets need to be general. They need to generalize what your role is as an analyst. And this helps prove to a recruiter that you know what banking is all about, right? Preparing detailed financial models. So you're not just kind of sitting in the corner getting thrown stuff and you kind of don't know what you're doing and you're throwing. Your responsibilities are modeling and valuation. So preparing detailed financial models, including merger and acquisition models and leverage buyout models. This is what everyone should aspire to. You might not get both unless you really want to push it in two, so you might not feel like you need leverage buyout models. But until you get there, which will be the end of the program, early stage guys or at this point, you should just focus on what you're doing right now. Preparing detailed financial models, complete with income statement, cash flow statement, balance sheet. Just focus on the operating model. That's what everyone's probably doing right now. Preparing detailed financial models, complete with income statement, cash flow statement, balance sheet, working capital schedule, depreciation schedule, debt schedule. So you probably won't even get there until end of this week or next week, and that's why I'm recommending for our talks to wait a little bit till you have a little bit more experience. But start with what you're actually doing now in terms of modeling and let that bullet evolve over time as you gain more information, skills. Right? But hopefully it'll end up to be doing full merger models, buyout models towards the end. If you're out here to the end, that's fine. Keep it, preparing detailed financial models complete with income statement, cash statement, balance sheet. That's fine. And then valuation, another key selling point. Valuing companies, valuing entities, using and list all the methods of valuation that we will learn next week. Multiples, discounted cash flow analysis, comparable company analysis. Right? As painful as it is, we'll talk about comps and you have to do it. I want to make sure that you guys are doing it because people ask it, have you put together a pitch book presentation? Have you done, they want to make sure that you are willing to do all the not so fun work in addition to the fun work, right? So you got to get everything done. And then everyone needs to have a selected transaction experience section on your resume, right? Most interns don't get that. Yes.
Is there a reason why you didn't put creating pitch books?
You could actually. You could. Some people have been doing that. I don't know why this guy just didn't do it. But yes, right. You could put a fourth bullet. So yeah, usually, and yeah, most everyone is doing that now. Has model, valuation, and then pitch book. Preparing pitch book presentations, detailing analysis results for senior management, for managing director, wherever it's. This proves that you're staffed on transactions, right? Select transaction experience section. Everyone should have one by now. By the end, you'll have, I recommend two. You might get three. I recommend two transactions that have quite a few bullets that you can understand inside and out. The more you have there, the more they're going to kind of test you on it. So I'd focus on two that you've really researched. You know the industry, you know the competitors. That's what I'd recommend. Here, what the deal is, right? M&A, buy-side acquisition for. That's the company that you're responsible for, that you're representing. Who are you representing, right? If it's like Pfizer's company, RPM, I don't know if anyone's doing that, but that was a big thing in the summer. That's the client, right? So it's an M&A buy-side for that client, right?
Should we be clients or should we try to avoid?
Don't put the name. So just the type of business, right? So for 3.3 billion multinational, you got to be vague. You can't name the client. Or you could say M&I buy-side acquisition of, if you want to represent the target company. So you can explain it in many different ways. It doesn't matter. But do you want to explain that who your client is? Do you want to explain who the target company is? Yeah.
If it's a closed peer review, what's the client's name?
I would talk to the firm. I'd talk to the company. I would just go by never putting the name down at all, just to be safe. I mean, it doesn't matter. You can talk about it in the interview. Even if it's closed, I don't know if they want it known who their clients are. You know what I'm saying? I think that's the perspective. It's competitive. But talk to them. Talk to the firm. And that's true throughout banking, right? And then what you did on the deal, right? And I'd recommend at least 3 bullets: model, analysis, and pitch book. And I know we have that above, but now it's specific to the deal to prove not only that you're staffed on a transaction, but you're proving to a recruiter that you're actually doing stuff on the transaction. Because a lot of times in internships, you're pulled on conference calls. You say, oh, I worked on this deal. But you just kind of sat on 3 conference calls, right? You're building the model. You're doing things that are important for the transaction. So explain that. So this is too general. I would have diligenced this further. I would say, the model that you built on the transaction and why. So again, you might not be there yet, but at least you can start thinking about this. So built full-scale model on target business to assess proper valuation for a potential acquisition, something like that. So it's more where this is general. This explains the level and depth of modeling that you're doing. This is explaining the actual model that you built on the deal and why. What's the purpose of it? Next bullet, some sort of valuation or analysis result. So in this case, to not be repetitive with valuation, I would say something like valued entity at between 3.6 to 3.9 billion, based on 7 to 8 times EBITDA multiple. We'll learn how to do this next week and the week after, week 3 and 4. But recruiters love detail and analysis results to show that you not only can build the model, you understand how to interpret it. It's important. Valuation resulted in. Right? And then next steps. Next steps will most likely be a presentation, so constructed, authored pitch book presentation detailing analysis and results for managing director, for client, whatever, some sort of output. And that's the idea. Right? Here he did here's an LBO. This is another example. If you're doing something a little bit more transactional. Constructed full-scale LBO model, right? Complete with, and I put in some kind of assumptions, high yield debt and term A loans at whatever, and we'll deal with all this in the last 4 weeks of the program, the LBO stuff. Base case analysis yielded 26% IRR based on 8 times EBITDA purchase multiple. This is an LBO result. Results are important. And then authored 2-page selling memorandum presenting potential opportunity to investment firms. Same idea, but it's demonstrating that you're covering all the bases. The model, the interpretive side, the output. That's what this is all about. It's clean, it's got structure, and it proves that you know what you're doing as an intern, which is important and rare.
When bulge bracket banks look at your resume,
yep.
Is it best to have deal size? Like, do they value deal size more, or like what you did specifically? Like, if it's more versatile?
I think what you do specifically. Yeah. In the beginning, we wanted guys to get deals closed on the resume. We realized the banks don't care about that. The banks are like, well, where's your pitch book? Because 90% of what you're doing is going to be pitching in the bulge bracket banks. So they don't want guys that just like, oh, I want to be a deal closer. And then they know they're going to sit there and complain and not do any work. So you got to get, we realize it's more than that. You need a well-rounded experience. You need to cover all bases and to prove to the banks that you know what it's like to be an analyst for 2 years, which is a lot of sitting around, a lot of comps, a lot of pitch books, and getting the transactional stuff, but that you're willing to do all of it. So yeah, so it's all about, and that's what's good about these companies, because they are big, but more importantly, they're running deals like a bulge bracket bank would. A lot of the smaller firms will just kind of throw things in the air. You know, they'll do kind of high level negotiations. They won't put together kind of solid pitch books. And for you guys, that you're just left with a lot of paperwork and legal stuff, which is like intern research. But these guys are running deals like the banks would, and that's what's important. They'll see that. Yeah. So you got to go through the whole process. Yeah.
So after you have a couple of deals on just like this resume, what about like should you like then delete other non-finance related work experience because it's irrelevant at this point?
Like underneath?
Yeah, of your resume.
I keep it there. I mean, you want to show progression. We want to talk about your story, and I'm going to do that with you guys individually. So once you have this laid out, even if it's like today, where you can just maybe put down just these 3 bullets for now, you know, just to start getting a thought process for what have you done in the past, and how can you talk about what you've done in the past with relation to what you're doing now to have a story. It could be just this. People have gone by, but it's good to have a couple other things there to show that you have a little bit of variety, but it also has to tie together. So we'll talk about that. You know, even your jumpstart guys are basically just doing equity research-based stuff. You still can be putting this, instead of select transaction experience, you'll list the equity research stuff that you're doing, and that's fine. We'll talk about that. But it's going to look very similar, right? You're still doing models. You're still doing valuation. You'll just have a bullet to say, created stock pitch for whatever. Yeah, and that's the first step. That'll be attractive to a lot of different areas. Who else has questions on this? Yeah.
It's not so much the resume itself as much
Yeah.
as the process for us, the hiring process.
Mm-hmm.
I know a lot of bulge bracket banks have
Yeah.
the programs, but they're usually meant for people going into the last year of university.
Yes.
So do we, for some of us who are recent graduated in June, do we fall into that category, or?
You wouldn't, but you would fall into the idea that these guys are focusing on hiring. So they're focusing on hiring. So there's definitely different stages of hiring, and we will slowly get to networking. But let's start talking about it now, because now it'll heat up in like 3 weeks. It'll heat up by the end of this month, really fast. First of all, you got a lot of bulge bracket banks that have hired analysts. They've gone through their June training program, and either analysts get cut, they drop out, they realize it's not for them, or their analysts are still looking around and they get picked off by like VC funds and private equity funds. Banks have a very, very difficult time filling those holes. It's a big problem. It's a big problem that I talked about. I'm trying to find a solution, but it's hard, and there's a lot of bureaucracy for that. But this is where you guys can fill a hole, because if you think about their process, they have just paid to put analysts through a training program, right? Who are they going to fill that have just gotten through a training program? It's either analysts that were at other banks in June, and then why are they looking for jobs? They must have gotten fired, right? Or they're going to have to put those analysts, they can't just hire somebody that hasn't gone through training. Otherwise, how are they going to compete with the analysts that have just gone through training? So maybe they can hire second-year analysts, but they can't do that. These are first-year analysts. They have a very difficult time hiring other people. This is exactly where you guys have a lot of benefit, and they're starting to see that. So you guys have gone through a training program, and you've worked on transactions, so you can fill those shoes. So it's those lateral hiring channels. So what I'm trying to say is, if you're reaching out to people, definitely go out to people on campus. Start by going on campus and reach out to these people. And they're going to say, well, we're looking for first year, analysts for next year now. But say, can you put me in touch with somebody that's focusing on lateral hiring? Because I guarantee there's going to be holes to fill. And take advantage of firms being active now and focusing on the HR initiative now. Not because they're going to be focusing on campus, but because now is the time that HR is active. So reach out. So the first thing I do is, number one, go to your alumni database, find out who are the first year analysts, second year analysts. You want to get to not necessarily HR, but there's always going to be an analyst or associate that's been tapped to focus on headcount for like 6 months. He's a banker that's focused. That's the guy you want to find. It's not really HR that does the hiring per se. HR does like the logistics and the background check. But the guy that says we want this guy is the associate or vice president that's responsible for headcount within that group. And he's going to be a banker that's been responsible for that for 6 months. You want to get in touch with that guy and say, is there a spot that you need to fill right now? Lateral hiring, things like that. If there's nobody from your school, then this is where you want to go to job boards, you want to go to job databases, you want to go to, I know, like Credit Suisse is hiring now, USB is hiring now, Goldman Sachs just posted on LinkedIn this morning, or weekend, for an analyst in their energy group, or healthcare group, or first-year analysts. Look at that. I'll post the stuff. Did you guys get into our alumni group? No. Oh, okay, let me include you guys on that today. And then I start posting things that I find too. You can probably find that now, but I'll also post the stuff that I find too. And reach out to those guys. But when you apply blindly, in other words, it's not through like an alum. A lot of people say you send the email out and it goes into like a mysterious, and it does. It goes nowhere because they get like thousands of resumes and they don't filter it out well. But it at least is telling you there's a job opening opportunity available. So what you got to do is use LinkedIn and use a search bar, like a Google kind of thing, and just search Goldman Sachs Energy and see what analysts or associates come up, because you know that there's a spot that needs to be filled in that group. And email those people. Don't connect. If you connect, they're going to be like, I don't know this guy. They might accept your connection or not. And even if you do like a note next to connect, you can't respond to that. It's really weird how that's done. But an email goes right to somebody's inbox. Send them an email. Make sure you put in that email a respond to address, because a lot of times people can read those emails, especially at the front, but they can't respond. It's like blocked. So make sure you put you can reach me at your email in there. And explain yourself, right? To write a quick 4-sentence email. When we sit down and talk about your resume, I want you to start crafting a 4-sentence email that explains yourself, because they're going to see a firm on your resume and they're going to say, well, why do you want to do banking? Are you here forever? Why do you want to leave? You've got to explain your situation. You've got to explain where you're at. And you basically say, you introduce yourself. This is my name. This is where I'm from. I'm a recent graduate of, or whatever. Explain yourself. 2, why are you reaching out to him? I'm reaching out to you because I noticed that there's a job opening at Goldman Sachs Energy, whatever. 3, you got to sell yourself. You got to let them know that now it's not like people get all the time, at least when I was in I'm trying to break in, right? It's not about that anymore, right? You have the modeling, you're trained, you're working on transactions, you're kind of in the game, and you got to let them know that, and that's what they're looking for. So you got to say, I'm currently working at a small boutique investment firm on Wall Street, or whatever you have to position it, or I'm currently working on, buy side, sell side M&A transactions, responsible for building full-scale financial models, conducting valuation analyses, authoring pitch book presentations. You've got to sell that. You're doing all the stuff that they want somebody to do. So write that down. I'm currently working on buy side, sell side, M&A transactions. Tweak it for you guys, what you're doing individually, where I'm responsible for building full-scale financial models, conducting valuation analyses, authoring pitch book presentations. Right? You can hit the ground running. Right? That's what you got to say. And then you got to explain it. Well, that sounds great. Then why are you leaving? And you say, so explain it. Although this is a great experience, it's unfortunately a short-term one, and I'm looking to transition this into a full-time analyst role. That's it. I realized, last sentence, you got to ask for an invitation for a call. I realized there's a job opening. I noticed on LinkedIn. Would you happen to have 5 minutes of your time, or can I invite you for coffee to discuss this potential opportunity? That's how you do it, and that's what works. Not everyone's going to respond. Expect 10% tops response rate is what I usually get from you guys. But the more you blanket it, and now's the time, the more. So don't worry, you don't even have to have, with LinkedIn, you can't attach resumes. So you can start at least finding these job positions and blasting out these 4-sentence emails, lining up calls. By the time that happens, next week after next, you'll have a resume together. So you can start at least that now. Any other questions at this point in time? And, my recommendation is create a spreadsheet and do it like, if you're a salesman at a company, maybe that, I don't know if that's like, but I was never a salesman. Well, banking is really sales, right? Put together a spreadsheet and list names of people. Just start gathering names, because to send an email, you need like a premium account, which is costly, So maybe just do that for a month, right? But until then, just start gathering names and have the spreadsheet in sections: investment banking contacts, private equity contacts, hedge fund contacts, and then subdivide that: alum, and just, I guess, other people, friends, family, others, right? And just start, so start by, all right, let me do LinkedIn, let me go into my old school alumni group, and let me search banking analysts and see who comes up, and just cut and paste their name, right? And then do private equity, and cut and paste their name, and then do it for any other people. Then just go out of your school group and just do analysts, see who you're connected with. Gather names and find time to send out like 5 to 10 emails, maybe even 20 a day to each name, and highlight them as you do it, so you might have reached out, and then, kind of take notes. Anyone that hasn't responded, send a second email in 2 weeks. Anyone that has responded, highlight them in yellow or something. So they're kind of hot lead. Keep it up that way, just so you make sure you're touching every base. It's gonna take a lot of work.
So the people who don't respond, I mean, do we email them again like once every week, 2 weeks, or?
If they don't respond, I touch base with them again in 2 weeks, and then maybe I'd leave it alone if they don't respond at all for a while, and just kind of note unresponsive, and maybe touch base with them in a month, lay off. The difficulty comes in where people are responsive in the beginning, and then it kind of drops off, which you'll find a lot, and you don't know why, and then you kind of want to keep up with them. But what I do is, what works a lot of people don't do and I think should do, is keep emailing them every 2 weeks and updating them with something new and interesting. Don't keep, just touch base. Email them with something new and interesting, and the best thing you can do is build a model, find a company that you like. It's probably premature to do this yet, but I'll start to recommend this by next month. Build a model of a company that you like, do a full analysis, pitch book, set of comps, everything. Because you can't email the stuff that you're working with at NYMEX or whatever. Build something of your own, email it to somebody, email it to the recruiter and say, hey, by the way, this is just, I want to send this to you. I built this on my own. I hope this will demonstrate my capabilities. So you're sending him something new and informative, and nobody does that. Like, wow, this guy can really build a model on his own. And he might say, all right, well, why don't you try it on this? And then he'll challenge you, and then you're at least building up. Send them the model, then 2 weeks later, send them the pitch book. Then 2 weeks later, keep giving him more information. And then if he completely doesn't respond, then don't. But I think it's a good trick to keep demonstrating stuff. But for you guys that can afford it, offer a trial. I think some people try it out, work for free. Don't say I'll work. Don't. That sounds desperate. What you can say is, listen, let me work on something small with you for a few months just to prove to you, I want to prove to you my capabilities. That's a constructive and confident way of saying, trying me out. Saying, I'll work for free. Let me, especially the smaller firms. Is there any model you want me to build? Can I build something for you just so you can demonstrate my capabilities? And hopefully you're learning how to work together, and that works. Okay, any other questions on that stuff? All right, so yes.
Is there like a reference where we can kind of see what the grading cycle is like, where first round interviews are, et cetera?
You mean like when they are and
stuff like that? Would that be on the company's website? I don't think they
No. The only way you get that is your university career center. If you saw that. The company won't say first round, second round, third round, things like that, because it's specific to each group, and then whatever school initiative in that group is different. And for lateral hiring, the benefit of lateral hiring is it's not as competitive, right? Because if you know they're coming to campus, then there's going to be like 40 people competing for one job, right? Or whatever it is. So the good news about lateral hiring is when you're in the interview process, you're probably competing with 2 or 3 other people, which is good. And hopefully you're going to be the few that have technical skills. The tough part about lateral hiring is it's going to take you more effort to find those opportunities and to be assertive enough to reach out for those opportunities. Whereas on campus, those opportunities basically came to you, right? Resume drops and all that stuff. And it was just scheduling account. That part was easy. So in this part, whereas getting after people is going to be the hard part. That's the initiative. Once you kind of get in the first round, second round interview process, it's going to be a little bit less competitive. So there's a trade-off. Yeah.
It's usually pretty standard 3 rounds of interviews, or it kind of varies.
For lateral hiring, it could be anything. If they're real desperate, it could just be an informational interview with a couple people in the MD, not even like a formal case study. Or if it's lateral, I've seen it go draw to like 3 months. We don't know if we really want somebody. Maybe we want somebody. All right, let's give them a model. Let's keep them busy. Let's give them a test, a case study. See in 2 weeks. It could be like that too. I've seen both. Yeah. All right, well, we'll keep doing this stuff, but at least the personal deliverable is to start thinking about the resume, right? Start gathering contacts for you to reach out to. And then 3, start kind of thinking about that 4-sentence email. All right, so to give some color and recapping last week, and I think maybe this is just a little bit overly simplified. Everyone knows what an income statement is, but just so you know where you should be, and if you're not so comfortable with this stuff, then you got chapter 1 in the book, right? We talked about the income statement. We know that income statement is financial performance, revenue minus expenses. But the thing is, for an analyst, how do you take an income statement that might have a lot of convoluted line items and resort them so that EBITDA comes to light, EBIT comes to light? That's what you want to do, right? So you want to just make sure you're identifying categories. And there are 9 categories for identifying line items into the income statement. There's revenue, there's cost of goods sold, right? There's operating expenses, some degree of operating expenses. Other income, remember we talked about the difference between other income and revenue. Other income is almost essentially revenue generated, but you cannot categorize it as revenue because it's not core to why the business was set up. But it's very similar. It's got to be reported because it's taxed. Other income. There's depreciation and amortization, right? There's interest expense, interest income, taxes, non-occurring events, distributions. Right? And where you know that revenue is also sales, revenue less COGS, less OPEX is EBITDA. This is the key for us as analysts. We want to know what's EBITDA for valuation and analysis, and the reasons we'll learn about next week. EBITDA, earnings before interest, taxes, depreciation, amortization. And part of the challenge there is that we faced for Walmart is that depreciation and amortization was not separately identified, which doesn't mean that it's not included in the income statement. It most likely is included in the income statement. It's just buried in one of these operating expense or cost of goods sold line items. We have to identify it and pull it out, right, to get EBITDA. Once you have EBITDA, you can subtract the components of EBITDA, namely depreciation and amortization, interest and taxes, to get from EBITDA to E. And that's kind of mechanical. Right? In the historical model, we've just identified depreciation, interest is identified, taxes are identified. We built to earnings. And then you have net income, and then you might have other categories if you see anything related to distributions or payout to equity holders, or things that you have identified as non-occurring should go underneath the net income because we want a clean net income. I say clean, void of non-occurring events, and before any payouts to equity holders. This is what we want to compare for analysis. And then we make projections. And when making projections, we did first cut assumptions at revenue based on growth, all costs above the EBITDA line based on percentage of revenue, and then depreciation and interest expense we left empty. In any full-scale model, you leave it empty because we're going to build a depreciation schedule and a debt schedule that will pull in depreciation, more proper and more accurate depreciation and interest expense in from those other schedules. We'll talk about how to do that this week, starting tomorrow. And taxes, we use the tax rate, not got us to net income. We really only care about EBITDA and net income for our analysis purposes. For projections, usually non-occurring events, we just keep it zero. It's non-occurring. And then on Thursday, we started talking about cash flow. So to better illustrate the need for cash flow, this is an example of a small distribution company. This company has generated $10,000 in revenues, and let's say they had various expenses, right? Let's say it's a small startup company. He had 1,500 salaries, that goes to SG&A. He had cost of goods sold, 2,500, 1,000 for fuel, 1,500 vehicle depreciation, 1,400 in taxes, right? So how does that look in an income statement perspective? This might be hard to read, but if you got the slides, you can see on the slides. We just lay out revenue less gross profit, less various expenses, excluding D&A to get to EBITDA, which is 5,000. And then you have depreciation, interest, taxes, everything laid out. My point is, no matter how you see and read expenses, you want to lay things out so that depreciation comes through, EBIT comes through, net income comes through, void of non-recurring events. I think that part's significant. But really, what's the difference between income and cash flow? Great, this is the income, which is important for GAAP purposes. This is explaining what's been reported. Why do I care about what's reported? Because you have sales, and initially you're taxed on sales, but as a benefit to businesses, you can reduce what would be 35% on, 40% on 10, or what would have been $4,000 in taxes. You can reduce those taxes by the expenses that were used to generate those sales. And so with the cost of goods sold, with the expenses, with the depreciation, I was able to reduce my taxable sales or taxable income down to 3,500 as opposed to 10,000. So I paid a lot less taxes, right? But that might not actually represent how much cash was in my bank account. Why? Because some of these items might have actually been paid in cash, some might not. I might get expenses that I put in there that I can use to reduce taxes that are bills sitting in my drawer that I actually never paid yet. Maybe this revenue, 10,000, this revenue might not actually have been received in cash. It might have been on credit. So although I have to record it as a sale and pay taxes on it, I'm not actually receiving cash for that. So the key difference between the cash flow and the income statement is, all right, well, this is the income report. How much of that is cash? And that's why as investors, we often more are concerned about cash. That's why we discount cash. We don't discount net income. There's not a discount net income analysis. Well, there is, but it's not widely used. We discount cash because the cash is indicative of what's actually going to go back to the investor. So we'll talk about how to estimate that. But that's according to cash flow. So let's say if you take that, this is the same income statement, 2,100, and identify which of these line items are actually attributable to cash and not, well, any portion of revenue that hasn't been received yet in cash is accounts receivable. Cost of goods sold here is listed as accounts payable, or really also it gets recorded as an adjustment to inventory. Expenses, any expenses that have not yet been paid in cash is accrued expenses. Depreciation is never cash, right? You never pay depreciation. You don't write a check for depreciation to anybody. There's accounting for aging of assets we'll learn later. That's depreciation. Taxes that might not be paid are deferred taxes. And interest expense is zero because interest is something that you always want to pay. If you're not paying interest, you're defaulting. So if you could think about all the possibilities, if you take the income statement layout, all the possibilities of the portions of income statement that could be deferred, it's AR, accounts payable or inventory, accrued expenses, depreciation, and deferred taxes. And this is the reason why the foundation of the cash flow statement is taking net income and adding back all the possible line items that could be deferred. You add back depreciation, you add back deferred taxes, and you make adjustments for accrued expenses, accounts payable, or accounts receivable. And we'll learn tomorrow why there's another word for accrued expenses, accounts receivable, accounts payable, inventory. It's called working capital. Working capital. It's a summary of these line items. We'll talk about working capital. There's a working capital schedule. But you might be familiar with the cash flow from operations formula, which is net income plus deferred taxes plus depreciation and amortization plus changes in working capital. And this is why you're basically just taking all the possibilities of an income statement and saying, what can be deferred? This is the foundation of a cash flow statement. But a cash flow statement talk about that in a different format when we talk about depreciation. A cash flow statement is broken up into three major categories: cash from operating activities, cash from investing activities, and cash from financing activities. So in this, no, I like this. In this income statement example, we have $2,100, right? So in this example, what this is saying is he needs to make some repairs on his truck. His repairs are $1,000. So he goes to his bank account and says, all right, well, I made $2,100 in profit. Let me make my $1,000 in repairs. But the reality is he doesn't have $1,000 in his bank account. So what? So I've made $2,100. I thought I had $2,100. No, there's a big difference between your net income and your cash. And so what this is illustrating is, well, in his specific case, there's a difference between net income and cash because some of these items need to be adjusted for. Some of these items did not actually come in cash. So in other words, of all this $10,000 in revenue that's been generated, not all of that came in cash yet. Right? Only $6,500 of that $10,000 came in cash. So $3,500 of that $10,000 is on credit. We need to adjust for that. Also, we'll assume that his COGS and his expenses were paid in cash, but depreciation is not. So if you say, all right, well, I have $2,100 in income, but the customer still owes me $3,500. I got to reduce that 21 by 3,500 to accurately represent what portion of that net income actually hit my cash account. At the same time, this $1,500 in depreciation expense is actually an expense that I never pay. So even though that reduced my net income, I want to add that back to accurately represent what portion of that net income represents cash. So if I take this net income and adjust for the cash that I did not get, the revenue that I did not yet get, and the expense that I did not actually pay. So if I take 2,100 and I remove that by 3,500, and I add back 1,500, then that's how I get 100 in cash flow. So my cash flow is too low. I actually do not have the $1,000 in repairs. So what do? I'm stuck. There are ways to liquidate some of this stuff. So we'll talk about that later on with depreciation, things like that. So he has a cash issue. It happens. You think you're making a lot of money, but didn't hit the cash count. This is why investors focus more on cash. So the cash flow statement focuses on three major categories. One is cash from operating activities, just what we spoke about. It's the cash portion from net income. Right? It's the net income, adding back deferred taxes, depreciation, other non-cash items we'll talk about, and changes in working capital. There are two other categories in cash beyond cash from just your operating activities that exemplify where cash can be generated or paid. One is cash from investing activities. And I think of cash from investing activities in two major categories: capital expenditures, or the payments reserved for property, plant, and equipment, improvements to property. This is the most important line item in the investing activities for analysis because this is the only line item underneath cash from operating activities that we care about for our DCF and evaluation. Anything else under this, we don't care about. We'll talk about why. But just so you know, other investing activities are items related to other types of investments, like buying assets, selling assets, buying businesses, investing in marketable securities. Those are the major categories for other investing activities. Other financing activities, I think about three categories: debt, equity, distributions. Right? It's money received from raising debt or money paid from paying debt, money received from raising equity or money paid from buying equity, buying securities, right? Buying back share buybacks. Or three, distributions, paying out equity holders, dividends, things like that. That's the cash flow statement simplified. Three major categories. Any questions on that? So When looking at Walmart, what we had done was, and what I asked you to do for homework, was to finish hard coding the cash flow statement. And this is definitely laid out in the three major categories we've identified in the PowerPoint presentation. So whereas in the income statement, you got to move things around for EBITDA, in the cash flow statement, you're pretty much just laying things out line by line. The cash flow statement should be best representative of really what the cash flow statements are. You'd hope that the accountants and whoever's putting this together have actually tied this cash flow statement to the bank account. And so we have net income. Just as this guy, they did this adjustment of discontinued operations. You don't have to know that, just do whatever they did. So we know that they did this adjustment, so we did this adjustment. And just like in the standard formula, they have an adjustment for depreciation and amortization, deferred taxes, other operating activities, and changes in working capital. We added everything up. Real simple, straightforward. Investing activities, here's the payments for property, plant, and equipment. This is CapEx. The rest is other, and I said other could be based on acquiring, divesting businesses, or investing in securities. Here, this is divesting businesses, disposing property. Here's buying businesses, business acquisitions. This other isn't clearly defined, but I'm going to guess it's buying and selling securities. A lot of companies do that, invest in funds, because of the swings here. Negative, positive, negative, positive. Probably selling some securities, buying some securities, selling some securities, moving it around. They're probably managing investments.
Does that factor in capital appreciation?
In terms of what? Besides capital?
I guess like the market value of those securities.
No. Good question. You do not in GAAP mark this stuff to market, and that was a big problem in 2008, 2009. We'll talk about that. No, you do not. It's a debate. It does not. Finance activities, again, debts, equity distributions, right? Borrowing, this is negative is paying back debt, positive is raising debt. Long-term debt, paying back, raising long-term debt. It's debts. Dividends, paying equity holders. Buying stock, purchase, this is buying a stake in a business is a financing activity because it was the minority interest investment. This is a one-off. Capital lease obligations is seen as debt. We'll model out capital lease obligations, and then other, who knows what that is, but that's what they laid it out as, so we'll lay it out the same. And then this one-off, it's one-off in terms of it's not in the three categories, but you'll see this in a lot of businesses. The effective exchange rate on cash. This is the impact of a company that has subsidiaries in many different business areas, what their impact is on when you roll up all the cash, the different cash flow items in different entities, what the impact is on that currency exchange rate. There's an adjustment that needs to be made. When you add everything together, meaning those three categories, plus this effective exchange rate on cash, this. And so now we want to project the cash flow statement as much as we can. So let's look at the template. First of all, net income. Anything that comes from the income statement, we'll continue to pull from the income statement. 2012, we pulled net income from the income statement. We'll copy this to the right. Remember how to copy to the right is you just hold down shift. You start with highlighting the item that you want to be copied to the right. Hold down shift and continue to tap the right arrow, which would highlight everything, including where you want that cell to be copied to. Let go, and then hold down control and hit right. Control R, copy right. And you do the same with the discontinued operations and the depreciation. Anything that came from the income statement. Now, notice discontinued operations is 0 because we clearly projected it as 0. I recommend that. For the cash flow statement, whatever you projected it as would have been added back anyway, thus reversing its effects. It doesn't matter. Yes, Terry.
I see some people when they do their model and they're linking the information from the second page, but it's number.
Oh yeah. That's kind of standard. I never did that at Morgan Stanley or JP Morgan, so some of the closed market banks, some banks are starting to do it. You can do it. I'm not going to be opposed to it. Yep. So in other words, if it's a link from another sheet, you can color it green. I don't personally see what purpose it serves. I just want to focus on what's driving the model versus what's a formula, blue and black. If you want to add that other tweak to it, go by all means, go ahead and do it. I just don't know what purpose it serves. I just think about it as an associate or when I'm vetting the model, which I would do all the time. I want to know, all right, what are the assumption drivers in the hard codes? Because that's the stuff as an analyst, as an associate, I need to research. I want to know where the assumptions. Stuff coming from other sheets doesn't help me there. You were going to say something. Just a personal opinion though. So no one's going to absolutely. You can color code as much as you want. You know. Have some fun with it. We'll get into getting articulate with drop-down boxes, different cases, and things like that. And I do believe the more you comment, the more of that stuff, the more coloring you have, the more color coding, the better your model can be. So just in terms of instruction, I personally keep it simple in the beginning. So it's a good and important question. Depreciation, however, is 0 because we didn't model it out yet. If you remember, we didn't link it in to the income statement. It was empty. We're going to build a depreciation schedule where we link it in. However, whatever you link it in as on the depreciation schedule, on the income statement, we will pull in from the income statement into the cash flow statement, income cash flow. So I'd still copy to the right. Once we populate it on the depreciation schedule and link it into the income statement, it'll trickle down into the cash flow statement. So we're going to keep that 0. Deferred taxes, will come from the depreciation schedule. We will talk about deferred taxes tomorrow. Other operating activities I want to talk about. You're going to find in the cash flow statement a lot of items that are other. You have no idea what they mean. And you're going to see this a lot, and it's frustrating. And a lot of analysts end up spending a lot of time researching on it. Again, falling into the technique where I would assume just get the model template done and then go back and research. I have a quick way to delineate down into how we can kind of make quick projections before you go back. We'll talk about that after the break. But I want to highlight, well, we'll do the highlighting after. But so usually we will model this out. This we can't do. This will come from the depreciation schedule. The working capital line items will come from the working capital schedule. So let me just highlight this stuff to indicate they will come from other schedules. I will not highlight other we're going to project in a second. This is just nothing. So items relative based on depreciation and deferred taxes will come from the depreciation schedule. The working capital stuff will come from the working capital schedule. We can simply copy to the right these formulas to get the template going so that once we have these line items populated, the totals will calculate through. And let's stop and take a break now before diving head first into making projections. We will project out. I want to project out this other operating line activity, and then talk about projecting some of these other line items, which may or may not be directly into it. So we're continuing with projecting out the cash flow statement, and really what you want to do is you want to project out as much as you can, and then you'll realize what pieces you need to kind of go back and fill out later when you have the supporting schedules. And getting to this other line item, so I see a lot of analysts get bogged down by these other line items, and just generally in thinking about projections, a couple things. One is we will realize, and part of the task as in being a good analyst is not only obviously putting in the hard codes, laying things out, being able to model, tweaking assumptions, but really understanding how to narrow down all these line items to the ones that matter. So when we do case studies in the last week of the program, part of the task is really to realize, you're given a full-blown model to build, but you're also supposed to explain What's the drivers in this model? And you have to have experience to be able to answer that question and to say, well, I mean, it's not going to be other operating activities. It's going to be something more major. How do you know which line items really impact the analysis? And that's the other point in modeling. It's not just the technical side. That's the other point that a lot of people don't realize until your second year, third year analyst, and then it's too late. So we will see that this line item can be relatively insignificant. So we'll talk about that. However, I definitely recommend that every single line item you should research. When I say research, do a word search on it, look in the annual report. If you can't find it in the annual report, maybe look in prior annual reports. Sometimes annual reports will explain something in one year and not the next year. I don't know why. Look in quarterly reports. Try to figure out, I mean, if it says other operating activities, just search for other operating activities. If it's a line item that is not other, but that's defined, but you don't know what it means, just kind of Google it a little bit, do some research on what that means. Obviously, use the guidance of us on the school side or the associates, but I mean, also just to be a little more independent. But no matter what you find, if they give you something specific, fine. But if you cannot research it, there are several things that you can do to project these line items. And I've narrowed it down to no matter what this line item could be, unless you're projecting it completely independently, there are 7 typical possibilities that an analyst uses to project line items that might not be defined. A lot of people use the average. Again, I don't like the average. I would always just throw that away because the average to me is not indicative of next year's performance, and if it's just 3 years. Yeah, we use historical averages over years and years and years to project fluctuations and volatility and things like that, and we'll deal with that. But in terms of business performance, I don't think so. But okay, that's one possibility. You take the average. Another possibility is just to be conservative and take the minimum. Take the smallest number. Right? Whatever's happened in the past few years, take the smallest number, just being conservative. The problem with that is if the smallest number was the most distant, maybe it's not indicative. So you want to kind of, guesstimate and use your judgment. But at the same time, it's conservative. So you can argue that it's conservative and you'd rather have a conservative model, right? Being conservative means getting less cash. So just in this case, right? The other thing you could do is have an aggressive model if you decide to do an aggressive model and take the maximum number, which is the middle number. Okay. So let me identify. It's too bad we don't have one board in this room, but let me identify the 7 possibilities. And one is take the average. 2 is take the minimum. 3 is the maximum. Another one that I recommend, and this is especially indicative of if you're in an kind of economic situation like 2008, 2009, that's kind of unusual, so you really can't count that as historicals, is to take the last year. We did this with the expenses of first cut. In other words, last year's performance might be most indicative of next year's performance. Maybe I'm giving you tools that you need to kind of make good judgment calls on that. 5, things can be cyclical, and we'll see one that is in this example. I would repeat the cycle, make it cyclical. Should have had a slide for this. 6, a lot of line items are based as a percentage of some operating line item, percentage of operating. We did percentage of operating when looking at cost of goods sold as a percentage of revenue. We will look at CapEx as a percentage of revenue. Some line items are based as a percentage of operating. 7, growth. Right? It could just be growing, climbing, or declining. So if you think about projecting things, unless you're reading a note saying that it will be 50 next year, unless you're reading something that's defined, these are all the possibilities to project line items. So my point is I'm trying to kind of break it down with, in order to be efficient, You could do some quick research, and yes, definitely when you have your model done, go back and research, and your model should evolve. But to be quick and efficient, you can take these 7 possibilities and slowly narrow it down, eliminating the obvious ones that it's not, or the ones that you don't care about, and I'll show you what I mean. So first of all, I don't like the average. I'm going to eliminate the average, okay? And I'm not going to take the maximum because that's an aggressive model. I always like to build conservative models. So I usually always throw those out. If we decide to build the model and say I want to have a conservative case and an aggressive case, then you'll think differently. Repeating the cycle. Okay, that's one to consider. Is this cyclical? And that's one to consider because this jumped. It was pretty consistent 2 years ago and last year. And then it bounced up. Whatever this is, because I have no idea what this is this a consistent jump? Is it steady every other year? Is it some minimal 300 and 1,000, 300, 1,000, 300, 1,000, 300, 1,000? To prove that, you look at an older annual report and go back a few more years. Right? Look at this 2010 annual report, and that will have 2010, 9, and 8. I don't know if that's the right number. Look at that 10, 9, 8, and see if there's 1,000. Well, I had done that, and it wasn't. It was consistent around 300. So repeat the cycle there. Percentage of operating, I mean, this could be like some expense that was an add back, right? This is getting operations. And to prove it, you can divide this by like OPEX, you can divide this by cost of goods sold, and see if the percentage is consistent. It's not going to be though because of this jump. Right? Basic jump to basic. So I would have a percentage that's like 20%, 50%, 20%. I know by looking at the way the numbers are moving. But if there were numbers like 318, 358, 398, 400, then I could say maybe this is growing in line with our operations. Could be. But it's not. And if you don't believe me, try it yourself. It's not growing because of that jump in the middle. It was, again, 318, 350, then it's growing. And then you want to think, well, how much is it growing by? Is it growing by 1 or 2%? And should I project it as 1 or 2% going forward? Or should I project it as a percentage of operating? This is just like how we analyze a cost in relation to revenue. So we've narrowed down, no matter how much you research this, even if you do research it and get good information, we've narrowed it down to 2 possibilities, the minimum over the last year. And this is where I'm saying those 2 possibilities are pretty similar. You could take the last year, 398, or you could take the minimum of 318, and you will realize that 60, although it's $60 million, it's not going to impact your valuation. We're talking about $250 billion in valuation. The difference between whether I chose 318 and 398 is not going to impact your valuation. Valuation, you come up with a range. So we've narrowed down something that might kind of cause a lot of worry into 2 possibilities that really aren't going to affect your analysis, whether you choose one or the other. So for that reason, I'm going to take the minimum just to be conservative. And I want to show you different ways for different, but this is a quick way to hone in on any possibility of projecting items and narrowing it down. And if you're really uncomfortable with it, what I always recommend doing is, if you're unsure about line items, even though you've projected them, highlight it red. And then when you're done with your analysis, maybe make a note saying, well, I took the minimum and maybe I could have taken the average. I took the minimum, maybe I could have taken last year. So when you're done with your analysis, switch that method and see if you change your answer. And you realize this is how you start to narrow it down. What are the variables and assumptions that really matter, that I really care about? Okay, so I'm going to take the minimum. And what I like to do is, even though I could have done equals 318, I want to put in the minimum formula to show to somebody that's looking at the model exactly what my thought process was. So I'm going to do equals MIN, that's the minimum formula. 398, 1087, 318. So this helps me when I go back and say, oh, I used the minimum formula. That's why I chose that. It would help me look into why I chose that. So I took the minimum, that gave me 318. You can't copy this to the right. It's not going to work. For H11, I'm going to have equal to G11. I'll copy that to the right. Anybody have questions on that? So the formula again? Next is CapEx. CapEx is one of those few line items that's often projected by management. You got to be careful because management can be a little bit too conservative. Right? Here, too aggressive. Here, conservative obviously is the biggest negative number. We often project CapEx as a percentage of revenue. That's just something that's standard. So if you do, I don't know if I have the report handy here. Let me, if you do a word search on capital expenditures, you would most likely find something that would give you an indication as to where it should be. So let's see if this comes up. If I do a word search on capital expenditures, capital, or just expenditures, it starts coming up. Okay, here it is. We define free cash flow. No, that's not it. That was it. Here it is. Cash flow from investing activities. These capital expenditures, we expect capital expenditures for property, plant, equipment to be between 13 and 14 billion. A little bit of a range, but if you're stuck, that's a good way that's a good place to go by. You can see it's climbing as revenue is climbing. You can either project this as growth or as a percentage of revenue. We typically do it as a percentage of revenue. I could have just taken their 13 to 14 billion kind of verbatim. I could have maybe been conservative and hard-coded 14 billion. I want to first look at it as a percentage of revenue to compare. So what I'm going to do is I'm going to add a row underneath CapEx. To add a row, I'm going to go to the row underneath, Shift and spacebar highlights the whole row. Hold down Shift, tap spacebar, highlights the whole row. Shift spacebar. All the hotkeys are in the back of the book. Yeah, Shift spacebar. And then Control Shift plus. Control Shift plus adds a row. Control Shift plus. And underneath, I'm going to put in percentage of revenue. I'm going to italicize that. That's the driver, percentage of revenue. And I'm going to calculate what the CapEx is as a percentage of revenue. CapEx divided by revenue, but I want my CapEx to be shown as a positive number. Right? So I'm not going to do CapEx divided by revenue. I'm going to do negative CapEx divided by revenue. Not at the top, but negative CapEx divided by revenue. And if I copy that to the right, and I want to just fix my formatting here, I'm going to make it a percentage. And I'm going to expand it out to 1 decimal. And I'm going to italicize it and make the font black because it's formula. It looks like it's pretty consistent at exactly 3%. And if it was bouncing around, I'd second guess it. It's at 3%. So it's safe to assume, since it's so consistent, that it will be 3% going forward. So I'm going to hard code 3%. I'm going to do 3%. And I'm going to just format it properly and make this now blue. I'm going to make it blue because it's an assumption driver. Hard code 3%. And then I'm going to take 3% of revenue with a minus sign because I want the CapEx to be shown as a negative number. So I'm going to do 3% times income statement total revenue. And it's actually beyond their expected predictions. So I'm glad we did it this way. They were probably being a little bit conservative. Or maybe our revenue growth is too high. We'll see. But 14.12 billion is beyond their maximum, this is more conservative. So I'm going to take both of these rows, I'm going to copy them to the right. Take a couple seconds, and I want to look at the formula there. Can you just show the formula again? Which one? The historical? Yeah. Mm-hmm. Make sure the numbers are matching. Here's the projection. Minus that cell times the interest. You guys okay with that? You? Yes.
Go to the income statement tab.
Yes.
Scroll up.
Yes. Got it? Okay. Still checking it out? Next we have proceeds from disposing equipment. So this is them maybe disposing old equipment. Apparently they've been doing that routinely. They've been making $1 billion to $500 million on doing that. And so we can look at the 7 methods. We can use the maximum, which I wouldn't because it's conservative to assume a minimal disposal. This is not declining. 7 methods. I don't like the average. It's not growing. Wasn't growing. It's bouncing. The average, I can take the minimum. I wouldn't take the maximum. That's most aggressive. I could take last year. It's not very cyclical. And it won't work on a percentage of operating because it's not moving smoothly. It's kind of dropping and then raising. Yeah. So again, we can take either the minimum or last year. We've narrowed it down to 2. What I had done though, in situations like this, if you think about what it's doing, right? They're selling equipment. There could be a possibility, now that I know what this is, that there's a year where they're not selling any equipment. I want to model out that possibility. Maybe that's too conservative, but in this type of situation, and again, you can use your own guesstimates, things like that, I want to be absolutely conservative and assume that there could be a year, maybe there's no activity at all. So I'm going to make this 0. That's just my argument. And you could say, no, I think that's too conservative. I would rather take the minimum because they've been doing it consistently. If it's disposing equipment, if you know what it is, I like to be as conservative as possible. But again, I'm just showing you different thought processes, Sammy.
Is this something we might find information about in the annual report?
You might. Yeah, every line item, just assume that you want to research and see, they might give you more information. Assuming they don't, right? Or at least as a first cut, right? I mean, there is concern that they're not going to have a need to dispose equipment in one certain year. So you can be very conservative.
Well, first of all,
Mm-hmm.
proceeds from disposals are bigger numbers than other operating activities.
Yeah.
Yeah, we projected that. Pretty sure even way we would project a smaller number.
Yeah.
It's not zero.
Yeah, because I know what this is. I don't know what this is. This is operating. This is operating. This is routine. There's a likelihood that this is going on and on and on indefinitely. I know what this is. I know what they're doing. They're selling property that they don't want. So I could come up with the possibility that this won't exist anymore. This is most likely an adjustment to something that's in net income because it's operating. So that's the reason. It's tough to just assume. So you make a good point. It's tough just to assume that anything can be zero unless you have a justifiable reason for it. Here I have a justifiable reason. I'm just picturing them selling property in China, build a story around it. This is an opinion too. So same thing here. Well, this is tricky. So investing in businesses, this line item is a lot of what you're building models for. If you're building a model on acquiring a company, why do you need to do that? Well, because ultimately you're probably going to, once a target's identified, if the target hasn't been identified, you're going to do a full merger where you merge them together. But in the beginning, you want to know what their financial capacity is. How are they going to pay for an acquisition? They did a $3.5 billion acquisition. Now, I know this company announced that they're done with acquisitions for a while, so I'm going to make this zero. But if you didn't, how do you know, right? This is why usually when you build a model, you're going to leave this empty in the beginning because you're building a model to determine how much funds do they have to make further acquisitions. And if they're going to do an acquisition, how are they going to fund it? Are they going to raise debt? Are they going to raise equity? Do they have cash on hand? Right? This is an M&A line. For that reason, this line item is usually for you guys in a deal. For an operating model, it's different. And in the annual report, they kind of announced that they're not going to do much. They did this M&A. They're going to hold off for a while. So this is easy for us, zero. But for you guys, when you know the company's in an M&A situation, what is this going to be? What are they going to buy next year? And that's why you might want to leave this out until the very end, right? You might not want, if you want a $20 billion acquisition, your cash is going to be negative maybe at the end. So you want to be careful. And for that reason, there are we'll talk about the higher level in a second. But note that with Walmart, I could have been conservative and took the minimum and said they're going to make a $3.5 billion acquisition every year. That's unrealistic, though. They're not going to do that. They even announced that they're okay for a while. So I'm going to assume that they're going to make no acquisitions. But for you guys, this is a line item that you have to revisit. If they have a surplus of cash flow, how are they going to use that cash? We're going to revisit this a little bit more in the financing activities as well. Other investing activities. Okay, we kind of talked about this. I don't know what this is, but most likely companies, especially big companies, buy securities, sell securities, buy securities. This is a repeat the cycle clearly because it's negative, positive, negative, positive, negative, positive. And if you look back over the past few years, it continued to negative, positive. So I'm going to repeat the cycle. And to do that, I'm just going to have the fourth year equal to the first year. And so when I copy to the right, the fifth year equals the second year, the sixth year equals the third year, and so on. That's the way I do it. You could have done it differently, maybe repeating the cycle but having it grow by a percentage, like this times 1 plus 5%, 5% higher. You could do your own derivatives, but this is the general thing that I would do, yes.
So this might seem like a silly question. When you say that companies typically buy securities and sell securities and so on, do you mean they do a sort of their own form of proprietary trading, or is it more so hedging against commodities, currencies, and things like that?
It could be both, depending on the type of company. I mean, in this case, in a very big company, I don't think it's really hedging. I think they just have a surplus of cash, and they want to make a little more money on it. So they're just putting it into mutual funds, just as a place to manage it better. They have a lot of cash, Walmart. If it's a bank, it'd be different, right? If it's an energy company that is driven off a commodity, maybe they're hedging against it, yeah. No, it's a good question. It's a tough call to generalize the answer. Just one quick thing to be careful of. So I've included a percentage in here. That percentage should not be in my total. My model won't balance. You'll see later. So I have to redo my formula to actually be equal to the individual line items excluding that 3%. I do not want that 3% to be in my total. It does make a difference. Everybody getting that? Okay, debts will come from the debt schedule. Anything related to debts will come from the debt schedule. That's short-term debt, that's long-term debt, that's also capital lease obligations. We treat capital leases as debts, so we will have the capital lease obligation in the debt section. Dividends paid is percent of operating. You can go through this analysis if you want to, but dividends are paid based on the number of shares outstanding. It's a net income item. It's a percentage. So we're going to base this off of the dividends that have been paid. So I'm going to add a row. Again, to add a row, I'm going to highlight the cell underneath dividends paid. Shift spacebar highlights the row. Then Control Shift plus adds the row. And if I do a word search, well, first thing I can do is I can calculate the dividends paid historically as a percentage of common shares outstanding by taking the dividends paid divided by the shares, or negative the dividends divided by, on the income statement, basic shares. You pay dividends on basic shares. I'm going to expand this into 2 decimals. You usually see dividends in 2 decimal places. And this is a formula.
So would you use the basic shares number? Would you use the one in the model part, or the one from the in the balance sheet? No, sorry.
I think we only got one place for it. Historically, this one.
Just there.
Now, I could have taken the last year. I see this is growing. I actually found a note though. Dividends. And it says, on March, they approved a dividend of $1.59, a 9% increase over the $1.46 from the year before. There's the year before is $1.46, and so they announced $1.59, so let's use $1.59. They specifically said what their dividends would be. How do you know to look for that? Again, I would just I would just always, by default, just try doing a quick word search on a line item before going through these methods. If you want to just go through the methods and just do a quick model template build and then go back and dig into research, do it that way. I think actually what I did was, while writing the book, I just did equal to 146, and then I later uncovered that note and had to update it. And that's usually what happens. You know, as you read the annual report, you find new things, like, oh, I should use that for my assumption, and then go back and slowly dig and have it evolve. Yes?
I guess for your initial assumption, why don't you just do a growth rate with the dividends? Okay.
It's not a steady growth rate.
We can average it's all going up.
Yeah, no, I could have, and so I didn't. So at this point, and even going forward, since it was climbing, yeah, definitely, it's not steady. That's the first thing. I could have assumed at least the most conservative growth rate, at least 3%, because the dividends have been climbing. But I didn't, to be conservative, and I honestly didn't want to convolute the book too much with another line item. You could have done that though. I just kept it flat at 159. I could have done the growth rate and taken it to that level. But knowing that they had that note, I just used the number of the note. I could have continued the growth as well further, 9%. I don't know what it was actually.
It's like 10%, 20%, 9%.
Yeah, 1029. I could have made a conservative 9%, but are they going to do that consistently every single year? I don't know. You could have. It's not going to, and then again, once anything you project under CapEx is not going to impact your valuation. So you could know 20%, 30%. It's not going to affect your valuation. So again, getting back to, we'll slowly learn about identifying things that you really should be concerned about or not. It's good to have something in there for the sake of a robust operating model, but it's not going to impact your valuation. Okay, let's back calculate into this. 159 times the common shares. Negative 159 times income statement. The common shares are standing. Basic shares. 3361. And copy everything to the right. Falls in line. Right? Okay. Next, we have treasury stock. Share buybacks. I could have used the 7 methods. I could have been conservative and taken the maximum. Or maybe I could have thought, this is double what's been previously. So this might have been a one-time initiative. And to prove that, I could look back another 5 years, like I had done with other, and seen, and you would see, that it was more consistently at 6, 7. I could take the last year. There's a couple ways I can do this. However, with equity, with raising equity and buying back equity, whenever you model raising equity or buying back equity, you need to go back to the income statement and adjust your shares accordingly. A lot of analysts forget to do that. If you're modeling out a share issuance, you got to go to your income statement and increase your shares. You've issued shares. Right? And what I've noticed is, on the income statement, there was a change between 3460 and 3361. There was a reduction in 99 shares between 3460 and 3361. If you've reduced shares, you have to assume they've bought those shares back. Right? And if I multiply 99 by 7382, if I just do this on the side, well, just to show you, if I do side calc, if I do 99 times $73.82, if they bought 99 shares, 7382, that's pretty darn close to what they've been doing. So I went with that as a good way to project share buybacks. Just a side rule with share issuances and share buybacks only, they have to be in line with the way the number of shares are shifting. So if you see a drop in the number of shares or an increase, you have to model out an assumption for share increases or share buybacks by the number of shares changed times the stock price. Conversely, if you've modeled out a share issuance or a share buyback, you need to make sure you're adjusting the shares. So what I'm going to say is, let's assume they're going to continue to buy back 99 shares a year. I probably should just round it to 200, but I already did in the book. 99 shares and model it out. And there's a lot of different ways you could have done this. But what I had done was I went to the income statement and I said, let me use this line to say shares bought, share buyback, or shares bought back. And I just hard-coded in 99 each year here. I just hard-coded in. I could have been more scientific about, I could have done a subtraction. There's a lot of different ways. I could have done a growth percentage. I could have looked at the historical numbers. I just was quick with this, just to show you, just to illustrate the necessity to make sure the way the shares change tie in with the financing activities of making projections. And then so for the cash flow to model out share buyback, and I wrote a note in here, I just did negative on the income statement, the number of shares bought back times 7382. Where did I get that initial 99? That's the reduction from 3460 to 3361. 99 shares went down. And I assumed that would continue. There's my 7308.2. Make sure you're with me on that. I actually think in the book I just hard-coded 99 times 73, which I wouldn't. I'd avoid. I just did that because it starts to get convoluted, but I would avoid hard-coding in numbers that you can find in other areas of the model. If you're hard, because you know why the mistake is, what happens if I update the share price? All right, if I update the share price go up to 80, I'll probably forget to go in here and change this. I'd probably forget. So always try to link as much as possible. That was, I don't know why I did that. Yeah.
Well, I just want to make the adjustment I keep saying to both the basic
Yep.
and the shares.
Yep. So once you have this, I'm going to make sure this is black. Now I can copy this to the right if I choose to. Oops. Oh, I got to anchor something. So hang on. Yeah. So if I copy this to the right, and we'll learn about anchoring tomorrow, but if I copy this to the right, let's see the next cell, I have a problem, right? Because this is taking H51 times E53. H51 times E53. H51 is 99. E53 is this empty cell. As I shift to the right, obviously the references of the formulas are going to shift. I want the reference to this to shift, but I don't want the reference down here to shift. I want to anchor the reference to this formula so that when I copy to the right, this does not move. You can do that by putting dollar signs around the cell. So we'll learn this more formally in the depreciation schedule, but as I copy this formula to the right, this G51, this is the 99 shares, I want this to move. With the reference to D53 to the share price, I don't want to move, so I'll put a dollar around the D. Dollar around the D means anchor that when you copy to the right, do not shift that reference, dollar D. Now I copy to the right and the reference is not moving. And so when I go to the income statement though, yeah, I got to make sure that since I'm buying back 99 shares each time, my basic and diluted shares can't stay flat. They have to reduce. So again, if you're projecting share buybacks and share issuances, you got to make sure that the average common shares will also adjust accordingly. So I have in 2013, that's 2013 is different. 2013 I pulled from underneath, but 2014 I have just equal to the year before. Now I want to say no, equal to the year before minus the shares I assume that have been bought back. I want the shares to reduce each time. 99, 99, 99, 99. Same thing with the diluted shares. Before I just said, just take it equal to the year before. Now equal to the year before minus the shares that have been bought back. So you got to be careful to make sure that you're synchronizing the rising and reduction of shares with share issuance and buyback in the financing activities. Review it in the book if you're kind of taking your time with that. Any questions? So now on the cash flow statement, we have this redeemable non-controlling interest. It's been 0 for 2 years. It's going to be 0. I want to mention something here. So they're paying $5 billion in dividends, right? Notice this changed. This was flat before at 53447. It's changed because we're having the shares reduce because of the buybacks. They're buying back $7 billion in shares. The M&A activity, right? When a company has a surplus of money, they're going to, when thinking about the cash flow, they're going to do a few things. They have the possibility to do a few things. One, M&A, right? Buy other companies. That's one. 2, pay or raise dividends, right? To attract shareholders. 3, buy back shares. Buy back shares has what impact on?
Share price usually goes up.
Anti-dilutive effect. There's less shares in the market, supply demand. You would hope would be rated higher. So companies, if they have a surplus in cash, would usually they'll focus on a host of initiatives, but a lot of times it would fall into dividends, share buybacks, or M&A. And of course, you guys are focusing on M&A. You guys might also do some share buybacks. It depends on the strategy. These 3 line items, I talk to them as these are line items that are based on share availability. In other words, you can use these several methods to project line items, but you also want to step back and guesstimate, does this make logical sense? In other words, I could have used those 3 line items and assumed that the proceeds of disposal of property, plant, and equipment is 49. But stepping back and thinking about what that line really means, I want to be super conservative and assume there could be a year where they're not divesting anything. And that could make sense, right? I could have used the 7 methods and concluded, well, the most conservative is for investments in business acquisitions, $3.5 billion. But to step back and think about the possibility of them doing a $3.5 billion acquisition every year is ridiculous, right? It doesn't make sense. Nor can they fund that. So when you build, a lot of times you might use these methods, you might step back and realize all of a sudden your cash is severely negative. You were probably too conservative. And you want to step back and look at the M&A, the share buybacks, and you want to look at the dividends. Those are 3 line items that I call items that are based on share availability. There's cash availability. Items based on cash availability. This is kind of what you're building the model for. If you remember, I started talking about the M&A, the 3.5 billion. I said, let me conclude this later. There are items based on, my handwriting's terrible, on cash availability. And I talk about it in the book. And what I'm saying is, despite the 7 methods, you do definitely want to step back and vet them and make sure they make logical sense. But you can go through the 7 methods real quick. You might have a real negative impact to cash flow, and that means that your M&A activity or your share buybacks or your dividends are being modeled too aggressively because companies will run these initiatives if they have a cash surplus.